Well, a sharp fall on Friday erased most of the week's gains, but the markets managed to extend its weekly winning streak to 7 weeks. On today's edition of the Editors Roundtable, we decode the IT firm's stellar performance, especially Infosys. We'll tell you what brokerages are expecting from Budget 2024 in a couple of days from now. We'll put the spotlight on defense and railway stocks, and we'll tell you why cash is king, especially for India's mutual fund industry. I'm Sonia Shenoy, and this Friday joining me, Anuj, Nimesh and Reema. Also, we have with us Vinay Jaising, the MD of JM Financials, who will be giving us his view on the market. Vinay, thank you for joining in. But folks, very interesting week for the market, right? We had some really good numbers coming from the likes of Infosys. We had lots of solid cues as well, but the end of the week saw a large bout of profit taking.
Yeah, only Friday was like a bit of a reality check. We've not seen this kind of corrections, right? I mean, in fact, since the beginning of this year, or ever since COVID, we've not seen very large corrections. So we saw that one in June when the election outcome came, but a bit of a reality check was needed. I guess that's what it was for today.
This also was a week in which we had technically 2 Fridays. One which felt like Friday and one which was a bit of a nightmare. Today being a bit of a nightmare because the market was down so much. Today was such a long day. The market just, at no point did the market attempt any kind of recovery. And despite that, we ended in the green and we had one day off. So a lot was there in this week. I think this morning we were making this point that the market was showing some signs of exuberance with put-call ratio at 1.41, with the FI long exposure at 4 lakh contracts. Now that's been the case for some time, but it looked like the market needed some kind of an excuse or some kind of a trigger. And the market was actually down today quite a bit, but still, overall, still a good week for the market.
A good week. And Anuj, we have been seeing this kind of moves in the market, right? It is an uninterrupted bull market so far, but every couple of months we see a sudden sharp slide. Yeah. Do you think that's the way the market is going to move?
I think on the broader market, that clearly is the case. Yeah. I think today also you saw, it's now fancy to say, okay, a mid-cap crash has started. But we have seen that so many times in the last 6 months that you don't want to say, okay, this is it.
Correct.
For all you know, post-budget, you might have a big rally as well. So
exactly. In fact, that's what my view is well. That there is so much of pessimism in the market. You talk to so many investors. The larger HNIs are sitting on cash. Mutual funds have raised cash levels, and there is no big commitment in this market, so to speak. We heard Ramesh Damani saying this, that he doesn't see any signs of too much of overcommitment in the market or too many leverage positions, right? So in that sense, you might see this few hundred points or few percentage points of corrections, but the fact that the positions, especially from the retail HNIs and the larger HNIs and retail investors, in the last many days have been a bit on the lower side. There is no big exuberance, so to speak. So maybe if the budget gives a reason to fall, maybe what happened to June 1st when the election outcome come, maybe that same thing can repeat. But on the other side, if there is no big negative surprise in the budget, maybe you'll see a big flow of liquidity, which can just take market to some another high. So again, that's something which need to be seen, early next week when the budget comes.
What the market has done with today's fall, I think, is also perhaps try to price in some kind of disappointment in terms of the capital gains tax. Yes. And if nothing happens on that front, I think that itself would be good for the market. Rally. That itself could lead to a relief rally. In fact, let's ask our expert, Vinay Jaising is joining us now. He's the MD of JM Financials. Vinay, hi, good evening. What's your view on how the market's position right now heading into the big event?
So a couple of things. First, I think people are not overly kept on cash. So though we say the mutual fund levels for cash is high, the AUM is also very high. So when we are talking about 1.5 lakh crores which are there with the mutual fund, that's about 5% of what the AUMs of mutual fund is. If you look at the average for the last 7 years, we're smack on there. Peak was about 6.5%, bottom was about 3%. So you're in a good state, right? What has, however, happened is, as you put it much better than I would have. There have been some spaces which had a huge exuberance in the past, especially in the capital goods spaces, where valuations were a question mark. People are waiting for the budget to see what's happening on the capex front. Are they overly populistic, or what's happening on the tax front? So, they're kind of booking profits a little bit in the shorter term, but, a 2% fall in, let's say, in the small cap today still gives the small cap at, probably 60% in the last year, the best performing market in the world. It doesn't change that. A bit of correction being healthy. People are just waiting for this event to see no bad news. And then you see more than the DIIs, which are, invested as much as $16 billion in the country since April. Is the FIIs, who've just invested $1 billion since April. But the most interesting thing is post-election, they've invested about $6 billion. So FIIs are waiting for the budget. As long as there's no bad news, I think, touch wood, we should see much higher days to come.
Okay, as long as there's no bad news, right? So let's see which way it goes. Let's not forget that yesterday was a down day, but we've had a relentless bull market in the last many weeks and months. One saving grace for today, though, was the IT companies, especially Infosys, that have been star performers all this week after large cap IT firms delivered in Q1. Rima, take us through what brokerages have said and what are we really seeing with the IT stocks?
Well, I just want to highlight three key takeaways or a read-through. One, there is some pickup, early signs of recovery in BFSI. Now, BFSI is important because that's the largest vertical in terms of contribution, 30 to 35%. So for Infosys in particular, revenue growth at 7.6% quarter on quarter after 6 quarters of a decline. TCS also clocked in a sequential recovery. The TCS management saying that North America BFSI did better than Europe BFSI, and even LTIMindtree echoed that BFSI clients saved a lot of money during costs, but now you're seeing some of those cost savings getting deployed into high transformation, high priority projects. So that's the key takeaway, that there is some recovery seen in BFSI. We have to see if it sustains. The second one is that there are some signs of recovery in the hiring, which was absolutely absent for more than about a year. So TCS hiring turned positive after 3 quarters, the highest that we've seen in the last 7 quarters. Infosys has said that they intend to hire fresh graduates, 15 to 20,000 from colleges this time. And the third one is that large cap IT has performed better than mid cap IT. In fact, so far, Infi, HCL Tech, TCS, LTIMindtree all reported the beat. The extent of beat was the most at Infosys, but even the others. But this time, mid cap IT has sort of failed to excite the street. We've seen some disappointments in terms of margins from Persistent today. Even Tata Tech was a disappointment. So, mid-cap IT was the big outperformer compared to large-cap IT in terms of growth and therefore even in stock price. But that appears to have reversed. And it's important because if mid-cap IT disappoints, they are trading at a premium valuation to large-cap IT. So that's something we need to watch. But broadly, IT has done so well, right?
Yeah.
24% since the beginning of June.
Absolutely. And Vinay, I wanted your thoughts on this because this is a space that has been a laggard for a while, right? But now the numbers are indicating, as Rima was pointing out, that perhaps the worst is over for the sector. Is this a good time to be lapping up on IT names, especially some of the large cap names?
So I don't think so. One should increase one's position, especially considering 2 things. As you put it, the IT space is up 24% in a couple of months. If you look at valuations, valuations are back to pre-COVID levels. But the earnings growth pre-COVID levels were 10 to 15%. And now we're saying the worst is behind us. We are not declining, we're growing, albeit the large cap are growing a bit more. But the growth rate is nowhere close to 10 to 15% for the sector as a whole. So what are we trying to buy, right? The question is, are we trying to buy a defensive which still depends on US, wherein there are a lot of pain on the interest rates being cut? Or are we trying to buy cash? Which we can keep cash itself as a position. I think we come from the latter, that yes, we agree that large cap are better than small cap, so we are swapping our bets from small cap to large cap. But we won't be very interested in being overweight. We are underweight in this space.
Okay, you're underweight on IT. Interesting. On the large cap IT names, got that. I'm also going to talk about what the expectations are from the union budget. I'm going to put all of that on board. But Vinay, before that, right, what is your key expectation this time around? You briefly spoke about it, but just wanted to understand, is there anything in the budget that can move the needle of the market?
I think rural expenditure, that's something which is lacking. Lots of investors or people we've spoken to seem to suggest that the current election was not in line with the expectation, largely because of rural expenditure being lower. The rural expenditure, in F24 was about 3.4 trillion, about 14% lesser than what it was in F2021. So that's something we're going to keep our eyes on. And rural expenditure includes affordable housing, which is PMAY. So I think these are the 2 big spaces where we would be looking out. Obviously, anything coming on the capex front, an increase from the 11.1 trillion which the government is planning to spend in capex will be another big positive. So for me, these are the 3 things to look out for as far as the budget is concerned.
Okay, so these are the three things you're looking out for. We also put together what brokerages are expecting from the budget since it's just a couple of days away. So let's take it straight to that. First up, Macquarie says that they expect the government to stick to their 5.1% fiscal deficit target for FY25. So that's the big expectation. Goldman Sachs says there is limited fiscal space to stimulate the economy given the high public debt that the government is sitting on. So don't expect too much of a stimulus for the economy because of the limited fiscal space. Jeffrey says that there is ample cushion provided by a much larger RBI dividend and tax buoyancy, which implies that the government can perhaps please everyone with higher capex, higher social spending, and yet a tighter fiscal. So in terms of sectors, if you're watching out for that, the budget should bring a positive for several domestic sectors, whether it's affordable housing, capex plays, consumer, as well as rate sensitives. And finally, you have Citi that says that there is an additional fiscal space of 0.45% of GDP even if the government decides to meet the fiscal deficit target of 5.1% of GDP. Allocation of available fiscal space will be on infrastructure, rural affordable housing, and favorable tax changes, if any, could be positive for consumer staples, autos, industrial, and real estate stocks. So, Vinay, you mentioned the rural plays, but I just wanted your thoughts also on autos and industrials, because these are two spaces where the street definitely has their eye on.
So, I think everything's pretty constant, right? RBI was kind enough to give a 2.1 trillion dividend to the government, and because of which you've got, somewhere close to 0.4, 0.5% of GDP to be invested. Will that gain in the auto space, or are the heydays of auto space behind us? You've seen Tata Motors more than triple, in the last year and a half because of what happened in Jaguar, their deleveraging story. What we are now hearing is in the auto space, first, the amount of consumption is now slowing down. You're looking at inventory levels inch up. So again, this is one space wherein we are not incrementally as constructive as we were earlier. On the latter, on the industrial part, we are very, very excited. Having said that, earlier we were grossly overweight. When I'm saying grossly overweight, capex and industrial, we were as much as 30-35% of the overall weightage of our portfolios in some portfolios. We may reduce that, but we'll be far more overweight than the past because that's where the capex spend for the country will happen. The fiscal deficit, even if it is at 5%, we think capex, rural spend, as well as affordable housing are three spaces, and all of them indirectly come under industrials, is where we are excited about.
Okay, got that. But speaking about the budget, right, Anuj, you've got some data about the railway and defense stocks. This is a space that, there is equal amount of FOMO as there is amount of people that have made money.
Yeah.
So what does one do now?
Yeah, I'm just relying on the data. And by the way, this data is courtesy Motilal Oswal research team. I asked them for their help. And what we are going to do is look at defense and railway stocks and whether they're overvalued or not. Let's start with the defense space. Let's look at how the market cap of the entire space, the entire defense space has moved. In FY20, it was just about 60,000 crores. It's moved up to 11 lakh crores. And most of that has happened in the last 3 years, from 1.75 lakh crores to 2.7 lakh crores to 6.2 lakh crores and 11 lakh crores. So roughly a 20 times jump is what we have seen. But have the profit kept in pace with that? Not really. 7,100 crores of profit in FY20. It's only gone up to 17,300 crores. So profit has gone up about 2.5 times. The market cap, the aggregate market cap has gone up 20 times. That's been the kind of run that we have seen in the defense stocks. Now, you could argue that in FY20, FY21, this space was undervalued, but surely now it's overvalued. Now, there's an interesting comparison I'm making. Let's look at the defense space and compare that to one stock, say Hindustan Unilever. In FY19, the aggregate defense market cap was 77,000 crores, which has now moved up to 11 lakh crores. In the same period, Hindustan Unilever market cap has moved from 4 lakh crores to only 6.2 lakh crores. Defense as a percentage of HUL was 19%. Now it's 179%. Now compare it to how the profit has moved for both the spaces. For defense, as I said earlier, 6,300 crores to 17,300 crores. Lever's profit has also gone up a lot, from 6,100 crores to 10,300 crores. But defense profit as percentage of lever has moved up from 104% to 169%. Let's look at the valuation, for example, now. In the defense space, the aggregate PE was 12 in FY19. It's moved up to 63, while lever has more or less remained same at 66. So, I mean, obviously it tells you that this space, which was perhaps undervalued in FY19 has now become grossly overvalued. I think the same comparison can be made with the railways space as well. Let's bring that on table. On railways, the aggregate market cap has moved up from 50,000 crores to 7.16 lakh crores. Again, bulk of that has happened in last 2 years, from 1.6 lakh crores to 7.2 lakh crores. But the profit has not kept pace. That plate would come up for you on the next screen. Yeah, there it is. From 50,000 crores to 7.16 lakh crores is what we have seen. Now, you would argue, as I said, that maybe right now we're looking at it because it's just started to move, and 2 or 3 years down the line, maybe this number would be much larger. Let me ask this question to Vinay then. Vinay, what's your view now on both railways and defense stocks?
So as far as defense is concerned, first and foremost, the government has increased the investments in defense by about 2 times in the last 10 years. More importantly, even in the breakup of the defense stocks, they're investing incrementally a lot more in domestic names. So, maybe as much as 6 to 7 times more is what the domestic names have got. Having said that, I would agree with you. There are some defense names which have gone, really up in the market, and their PEs have moved from 15, 20 times to 45, 50 times 1 year forward. But the order book also of some of them, especially names like Hindustan Aeronautics, are north of 7 to 8 times for the overall company, which means, you nicely compared HUL to HAL. One thing which is interesting is now, like the consumer sector, the growth in the defense sector because of geopolitical risk is a given. Whether it grows by 15 to 20% or higher, that is the question mark. Every budget, not just in India, but world over, will have one spend which is going to increase every year, and that's defense. So you can't rule that out. So we are still nibbling in the defense space. We did sell out in some of the defense names a little bit, trim down positions because they really went up too much. But this is something which we think now is a core holding for us in the future. Very different in the railway space. In the railway space, I think the overall industry volume growth, if you were to put the same tables on the wagons growing on a yearly basis and, add the year FY25 and just look at FY23 to 25, you've seen the growth go up something close to 7 to 8 fold into the supplies of wagons these guys would give in this year and FY25 and FY26. But post that, we got to wait and look at what's happening on the passenger part of the story. So I think the upside on railway stocks may be more limited than the upside on defense names, wherein we'll be nibbling a lot more and buying a lot more into the budget and keeping them as a core holding.
Okay, well, let's do one thing. Let's take a short commercial break on that note. When we come back from the break, we'll continue to put the spotlight on the market. We'll also talk about the Indian mutual fund industry, which is sitting on a whopping 1.25 lakh crore rupees in cash. More details on that when we return.
Well, there is an old saying in the market that cash is king, and that's exactly what the mutual fund industry is sitting on, which is 1.25 lakh crores of cash. Now, just look at the data. As I said, they're sitting on nearly 5% is the average cash levels, but in absolute terms, the cash levels is 1.25 lakh crores. And add to this, every month you're seeing an SIP of 21,000 crores. So that's the kind of liquidity the domestic mutual funds are sitting on at this point in time. If you look at the absolute numbers, the cash levels has since the beginning of the year, it was around 95,000 crores. Now that has gone to 1.25 lakh crores. But of course, the inflows have been higher. So that's the reason why the number has gone up from 95 to 1.25. But on an average, the AUMs, the mutual fund industry is sitting on an cash levels of 4 to 5% in the last 3 to 6 months. So that's been the average. But the next table is going to be quite interesting. What are among the mutual fund industry, who are the most aggressive ones in terms of having a cash call? PPFSA managing an equity portfolio of close to 75,000 crores, and they are sitting on almost 15% cash levels. The cash levels has gone up from almost 11.5% to now over 15% in the last 6 months. So that's the kind of aggressive cash levels PPFSA has taken. The next 3 are going to be quite interesting. SBI Mutual Fund, HDFC MF, and ICICI Pru MF, the 3 biggest mutual funds in this country in terms of asset under management, all managing close to 3 lakh crores of equity AUM. And the average cash levels for these 3 firms is between 7 to 8%. So 7.5 is what I can say is the average cash that these 3 large funds, large AMCs are sitting on. Even Quant Mutual Fund has raised the cash levels. They are sitting on almost 81,000 crores of equity. Their cash levels have gone up from 3.8 to nearly 5% now. So that's the kind of cash which the mutual fund industry is sitting on. And to add to this, if you look at the PMS, the AIFs, the family offices, if I just assume 9 lakh crores of cash that the PMS is sitting on, 5% of that would mean another 50,000 crores. So that's the kind of liquidity which is there in the system. And any given, if there is a larger fall, I guess that's the amount of money which can cushion a large fall in the market. So that's why I thought I'll highlight this number. Vinay, as a fund manager, I want to ask you, this is the kind of money which is there in the system. How does it work, right? I mean, of course, the absolute number looks big, but in a larger fall, how do mutual funds or fund managers like you deploy this kind of cash levels?
So, we firstly don't have that much of cash in the system. We have under 3%. But as you rightly said, 5% is an average number which the mutual fund industry has had in the last 5 odd years. So it's just that the AUMs have become so big that the 1.25 or 1.5 lakh number, which we believe is in the system, looks very high. But what do you do with this money is, if you see a stock which during the budget time corrects substantially and your core thesis remains the same, that's the time wherein you would start looking at buying or bottom fishing those spaces, right? Now's the time for you to buy stocks, let's say in specialty chemicals or pharmaceuticals, which are, not done so well in the last year. The excess cash ammo which you've created would be largely for any corrections which you think are one-offs, wherein either the government had said something in the budget and the market has probably got it wrong in the short term. You saw that during the election week as well, how the market first yo-yoed. You had during the lunch hour, people were wondering if the trades would be suspended even for NSE, and then 1 to 2 days later, you started seeing everyone who sold on those days couldn't get back their performance. So for our perspective, we are remaining invested with a small cash treasure, but I'm pretty confident people with 5% are waiting for that day of the budget, seeing if there is a change of the stock prices, not what the budget is saying, and they think it's the change is for the wrong, they would start nibbling onto those sectors.
Okay, well, Vinay, we don't have to wait too long, and next week is a very exciting week for the market. We'll be reacting to Reliance's numbers on Monday. We'll have the union budget on Tuesday, and through the course of the week, so many nifty companies come out with their earnings as well. So it's going to be an action-packed week. And with that, it's a wrap on this week's edition of the Editors Roundtable. Thanks a lot for watching, but don't go anywhere. Lots of news and updates coming up on the other side.